in real estate or not, but I think it's particularly important for real estate investors to track your progress. So let's talk about that. I believe you should have a net worth statement. So you should have somewhere, and we'll talk about the different formats for this, but a place where you are tracking your assets. How much do you have in the bank? How much is property one worth? How much is your home worth? How much is your business worth? How much is your 401k worth? Your IRA? You list all of your assets. And then also, you, in the next column, you keep track of your debts, money that's owed. It could be mortgage on your home, mortgage on one or more investment properties, car loan, student loan, personal loan, credit cards. You want to add up your debts. And you want to track your net worth, which is found by adding up your assets, coming up with a total, adding up your debts, coming up with a total. Then you subtract your debts from your assets, and that gives you your net worth. Of course, if you're investing in real estate, can it be fun? Yes. Can it be fulfilling? Of course. But you're really doing this to build wealth by having equity in properties, by having the properties increase in value over time, and also by generating positive cash flow that you could use to invest and or live off of. But if you're not keeping track of your net worth, how do you know if you're winning? It's the key way to keep track of winning. And the only two levers we can really pull, and this is simple but effective, the only two levers we could pull is increase your assets and or decrease your debts. If I increase my assets, I'm going to drive my net worth higher. And if I decrease my debts, I am going to drive my net worth higher. I could go back over several years and I could see how my personal plan has unfolded as I've increased my assets and decreased my debts, driving my net worth forward. And that tells me if what I'm doing overall in my household, in my goal of becoming wealthier, is working or not. So we have some powerful software that we work with our clients on. It's called Right Capital, and we keep track of client net worth statements increasingly in that system. But before I used that system on a personal level, I just did it on an Excel spreadsheet. In fact, I still have it. I'm a little old school at 48 years old. But you need your net worth statement. For properties, you should have a profit and loss statement. If you have one property, you should have a P&L for that property. You want to be able to look at that property and to see how it is performing as a standalone business, as a standalone investment. And so you could do that on paper and pen, Excel. In my household, we use QuickBooks. There's other software out there that you could use, but you want to have your P&L. So let's assume you have one property. You should be able to tell, is the property making money or not? What are the expenses? What are the rents? And be able to pull up this one-page report, profit and loss statement, that'll give you a very, very accurate depiction of what's going on with the property from a numbers perspective. If you have several properties, you should have a P&L for each property, in my opinion. And then you should also have a P&L for the properties as a group. If you only have a P&L for the properties as a group, it may mask some problems. For example, let's say you have 3 properties and 2 properties are performing wonderfully well, but one is problematic. If you only look at the group P&L, you may not notice that one of the properties is being subsidized by the strength of the other 2 properties. And you want to know that kind of thing. Now, if you only do individuals, especially as you build up a portfolio of properties, you may not want to always look at 2, 3, 4, 5 P&Ls. And at times you want to look at how the portfolio of properties itself is performing. So that's why you'd want to have a group P&L. If you're using something like QuickBooks, this is very, very easy. If you have questions, you could contact us here at Elliott Wealth Management. We could help you or point you in the right direction. I mentioned earlier, you have a team, your CPA, and the accounting firm you work with can help you typically with these types of things. So you should have a profit and loss statement. Lastly, under track your progress, you should have an income statement. I'm a big believer in multiple streams of income. I do that within the business here at Elliott Wealth Management. We want to be able to generate income from a variety of different sources by providing services to our clients. And me personally, I want to have multiple streams of income. I have my real estate, I have my investments, I have my business. My wife Joelle has some sideline hustles. So we have multiple streams of income. Not everybody has that. Not everybody wants that. It's not necessary to be successful financially. But for real estate investors, I want you to have an income statement. You should be tracking where your income comes from. So as an example, let's say you're employed and you have a job, a 9-to-5 kind of job. You'd want to have that on your income statement. And let's say you have 2 investment properties and they're generating income. You want to see what kind of income those properties are generating. Let's say you're getting alimony or you're getting some income through a legal settlement, whatever. It could be any number of examples. But you want to see where your income is coming from. Lots of people invest in real estate with the idea that they could build up a passive amount of income, cash flow from one or more properties. But how do you know if you're winning at that if you are not tracking it on your income statement? So the 3 primary documents I want you to pay attention to are the net worth statement, the profit and loss statement, and lastly, the income statement. You need to track your progress. Otherwise, how do you know if you're being successful? How do you know if you're winning? How do you know if you're getting better at things? And it's not to say that there are not ups and downs in any of these financials and these documents. I've been a real estate investor. There's years where properties struggle. You might have tenant issues. The market might decline. You may have to put money into properties. It's not always forward progress, but you do want forward progress over time, and the only way that you can do that is to track your progress. Keeping in mind, what I'm talking about is not hours upon hours of tracking and number crunching and inputting data. This could all be done quite easily, a few hours a month perhaps, maybe even less, but it'll do wonders for your wealth building plan. So moving along, number 5 is be diversified. I'm a big believer in real estate, but I also think that you should work towards accumulating wealth in other areas. I'm a believer investing in stocks over the long term, whether it's individual stocks, mutual funds, exchange traded funds. We could cover that in another episode, but I believe in building wealth through investing in the stock market over the long term. And you could carry that out by using 401ks, IRAs, 529 plan college funds, non-retirement brokerage accounts where you have a little more liquidity. There's a variety of ways that you could do that. I'm a firm believer in that. That's what I do at Elliott Wealth Management Services. That's one of our core competencies. It's what I've done personally and will continue to do. I don't want to have all my money in real estate. As terrific as real estate is and can be, it's not a silver bullet. It lacks liquidity. You might be dealing with tenants, and that's not always easy. Real estate markets can decline. They can be slow. They can cost you money in terms of improvements. There's just a lot that goes into it. I'm a firm believer in building wealth through a diversified strategy that could incorporate real estate investing, but it shouldn't be the only thing that you're using to drive your wealth forward. I think that is a major strategic mistake, and it's fraught with too much danger, the type that I do not want to be a part of. You want to be diversified. I always have the mentality that I don't want to do anything to blow myself up. I don't want to ever put so much risk on the table where I could undo a lot of the good that was done previously through my hard work and smarts and moxie. I don't want to ever blow myself up. So keep that in mind. You don't want to take too much risk. Now, a word about that. If you're listening to this and you're young and you're an upstart and you haven't done anything, you're probably going to need to take some risk. because you can't do everything all at once. But for those of you that have had some experiences and have moved along, if you have net worth of X, all of X shouldn't be in one place. 80, 90% I do not believe should be in any one place. You need to be diversified. This is a way to mitigate your risk so that if you have a setback, you're still in the game and you could come back without having to start from zero again. And I'll point out that there are other opportunities out there. You could build wealth through small business ownership. You could build wealth through investing in the stock market, especially over the long term. You could build wealth in real estate. There's lots and lots of ways that you could build wealth. So you want to take advantage of other opportunities, even if one of them is real estate investing. And that could be a major part of your wealth building plan. I have no problem with that, but it shouldn't be the only component. So be diversified. The last thing I wanted to talk about is be careful with debt. My views on this have evolved quite a bit over the years. Many of you, if you're a real estate investor, will be familiar with Robert Kiyosaki, who wrote the very successful and well-followed book, Rich Dad, Poor Dad. And I'm a big fan of his. I'm a big fan of his book. I've read many of the other books that his organization has put out, including Cash Flow Quadrant, which I think is outstanding as well. As much as I'm a fan, though, I've come to believe that his attitude towards debt is a little lackadaisical for my taste. Debt is dangerous. It provides you leverage. It could allow you to do things that you wouldn't otherwise do. There's a lot of good involved in real estate, but it's a dangerous tool, and it could bring about a situation where you take on too much debt. And going back to number 5, be diversified. I don't want to blow myself up. A way that a lot of people blow themselves up is taking on too much debt, and then if and when trouble arrives, they can't overcome the servicing of the debt. So Robert Kiyosaki seems very carefree about debt. I wouldn't subscribe to that. I think you need to be more discriminating, more careful, more sensitive about debt. At the same time, I'll give you the other end of the spectrum. Dave Ramsey is one of the most popular money gurus out there. He has a very popular book, just like Robert Kiyosaki, and he is a no debt person. He doesn't believe you should borrow money for anything. Actually, his natural tendency is that you wouldn't even borrow to get into your first home. He's a little soft on that, but he is a big believer in no debt. If you're a business owner, you don't expand your business by getting a credit line through the business. You just bootstrap it and cash flow it yourself. And he has one of the, I think it's the number 3 most popular podcast in the country. So Dave Ramsey is super successful. Ramsey Solutions, super successful. I think that on the opposite end of the Robert Kiyosaki spectrum is a little too strict. I've used debt, and it's been, in some instances, many instances, very worthwhile. I've also had other times when I've done debt and it's been regrettable. It's allowed me to make decisions that I shouldn't make decisions, and it's been problematic when you encounter some trouble. So I'm a little bit in the middle of those two individuals. Granted, I'm not nearly as well known as either of them. So my counsel to people, my counsel to you is to be careful with debt. Don't get too overexcited. Don't overextend yourself too much, because debt can wreck you in a hurry, and interest cost will really sap cash flow in a very big way. So you want to be very careful about that. Again, very discriminating. On the flip side, do I think you should swear off debt and never borrow any money? No, I think that is too extreme as well. I think a dividing line, and even Robert Kiyosaki would buy into this, there is a difference between debt. Like, I want to go on vacation, but I have no money, so I'm going to put it on the credit card, and I'm going to pay 20% interest in perpetuity. That's dumb. That's not what I'm talking about. Consumer debt. Should be really careful with car loans. Pay off your student loans. Don't live above